The money in your bank account doesn't really exist. This isn't a theory, and it's not a lie. If everyone went to the bank tomorrow and said, "I want to withdraw my money," the system would collapse within hours, because that money simply isn't there. And no, this isn't a mistake. It's exactly how the system was designed to work. The global financial system was built this way on purpose. It's such an old, deeply rooted structure that we've come to accept it as normal. It's called fractional reserve banking. And this system is the silent engine behind global debt, inflation, and the illusion of wealth. Once you understand how it works, you realize that money has never really been anything more than promises that can never all be fulfilled at once. To understand this, we have to go back to a time before digital apps and online banking. In medieval Europe, money was gold and silver. If you were rich, you had chests full of gold coins or jewels to trade. But walking around with bags of gold was dangerous, so people began entrusting their valuables to goldsmiths, men with strong safes and solid reputations. In return, the goldsmith would give them a written and signed receipt that said, "Bring this note back and you can reclaim your gold." Before long, people realized something. They didn't need to carry gold anymore. They could just trade those paper notes. The note represented value, and it was far easier to carry. And that's where the trick began. The goldsmiths noticed something. Almost nobody came to collect their gold at the same time. Out of 100 customers, maybe 1 or 2 showed up in a day. So most of the gold just sat there, untouched. Then came the idea. If everyone isn't withdrawing their gold at once, why not issue more notes than I actually have? If a goldsmith had 1,000 coins, he could issue 2,000 receipts. He could lend out those extra notes with interest, earning profit on gold that didn't even exist. As long as everyone didn't demand their gold simultaneously, nobody noticed. In short, they had created money out of thin air. And it wasn't just a clever scam, it was revolutionary. Because once people started treating a piece of paper as valuable as gold itself, money became completely detached from physical reality. Banks were born from this trick, and they institutionalized it. Governments soon caught on and adopted it for themselves. In 1694, the Bank of England was founded, not to serve the public, but to rescue a kingdom drowning in war debt. The bank lent the government far more money than it actually held, in exchange for interest. That debt wasn't repaid with treasure or conquest, but with the taxes of the ordinary people. Sound familiar? Because that's exactly what happens today. Governments borrow money that doesn't exist, and future generations pay the bill without realizing it. America followed the same path. Early American banks printed notes backed by gold, but soon discovered, we can print more than we actually have. And they did, until the day people rushed in demanding their gold, and the banks collapsed overnight. Instead of ending the system, what did they do? They created central banks to protect the illusion. The message was clear. Even if the money isn't real, the people must keep believing it is. Now, let's fast forward to today. Say you deposit $100 into your bank. You probably think your money is sitting there safely. But in reality, the bank only keeps a small fraction of it. It used to be around 10%. That means they'd hold $10 and lend out the other $90. Someone spends that $90 at a store. The store owner deposits it into another bank. That bank keeps $9 and lends out $81. This cycle keeps repeating. In the end, your original $100 becomes almost $1,000 circulating in the economy. But only the first $10 actually exists. The rest is debt. Every new dollar is born as debt, money that must be repaid with interest. And here's the scary part. Even that story is outdated, because today in the United States, the reserve requirement isn't 10%, it's 0. Since 2020, banks haven't been required to hold even a single dollar in reserve. So why don't they just hand out infinite loans? Because the leash today isn't reserves, it's regulation. Global capital and liquidity rules, written in Basel, Switzerland, by central bankers and unelected technocrats. Here's how it works in simple terms. If a bank wants to issue a risky $100 loan, it has to keep maybe $8 of its own money as capital. That's the real limit. The more risk they take, the more capital they must hold. And they must also hold liquid assets, like cash or government bonds, in case of short-term crises. But here's the key difference. Banks no longer lend money from deposits. It's the opposite now. They create the loan first. And that loan creates the deposit. When you take out a mortgage, the bank doesn't pull cash out of a vault. They simply type new numbers into your account. That money appears because you agreed to repay it. That's why over 90% of all money in circulation today isn't central bank money. It's bank money, created out of nothing every time a loan is made. And this system produces three major consequences: inflation. As the same dollar is multiplied again and again, each one becomes worth less. Prices rise, not just because of supply and demand, but because the money itself is diluted. Perpetual debt. Because money is born as debt, there's always more debt than there is money to repay it. Interest guarantees the cycle never ends. Concentration of power. Banks earn interest on money that doesn't exist. Governments use this system to fund wars, bailouts, and programs without raising taxes directly. And the wealthy, the asset owners, grow richer as inflation pushes up asset prices, while ordinary workers lose purchasing power. We've seen the illusion crack before. In 1929, the Great Depression hit. Banks had lent far beyond their reserves, fueling a stock bubble. When panic struck and people demanded their money, it wasn't there. Thousands of banks collapsed. In 2008, history repeated itself, this time with mortgages. Banks once again multiplied non-existent money, and when defaults spread, the system was on the brink of collapse. Governments and central banks printed trillions to keep the illusion alive, because without it, modern economies would have died overnight. Today, the system is global. In the US, the reserve ratio is zero. Both Europe, the UK, Canada, and Australia are already the same. All follow the Basel rules. Only countries like China, India, and Brazil still maintain higher reserve ratios, but even there, Basel ultimately sets the boundaries. Wherever you live, the real break on money creation isn't how much cash sits in the vault. It's a rulebook written in Basel, Switzerland. And here's the unsettling truth. This system can't survive if you're debt-free. If everyone repaid their loans tomorrow, the money supply would collapse. Banks wouldn't have anything to lend. Economies would freeze. The system needs you to believe, to borrow, to spend, to trust, that the numbers in your account are real. You are both the fuel and the collateral. That's why history matters. The goldsmiths' ancient profit-from-nothing trick became the foundation of modern finance. And the danger remains the same. Every crisis is just a new version of the same story. Promises that exceed reality. And people who still believe in them. Remember this. The story isn't over. The stability of the system doesn't rely on gold or productivity. It relies on trust, and trust is the easiest thing to lose. So the next time you look at your bank account, remember, most of that money isn't really there. It exists only on paper, born from debt, designed not for your freedom, but for the system's survival. If you understand the trick, you can protect yourself. If you ignore it, you'll just remain a player in a game that was never built for you to win. If this gave you a new perspective, don't forget to subscribe, because the answers are hidden in history, and I'm just here to show you where to look.